There we go. Okay, so as you'll see, the agenda for today, we'll do call to order, and then we're going to do an introduction to rebalancing, as well as some information on financial ratios and valuations, followed by a active versus core equity classification decision that we made recently, as well, and then followed by a proposal to rebalance some equities in the portfolio. And then we'll adjourn. June will be sending out a form that will ask to approve last meeting's minutes and also approve the agenda for today. It'll also include some voting points for today on some things that we're going to discuss, so make sure to check that out, and she'll send those results out following the end of the meeting. Okay, so we're going to get started. Okay, so up first, I'm going to talk a little bit about portfolio rebalancing. So what does rebalancing a portfolio mean? So essentially, to rebalance a portfolio is not to necessarily sell the entire position in like an equity, a fund, a bond, whatever it may be, but rather reduce the size. This helps keep the original allocations in check, therefore creating similar amounts of risk exposure over time. So as you'll see in this graphic below from Vanguard, you'll see how a portfolio rebalanced annually over 30 years, that the bonds and the stock allocation stays pretty similar. However, on the right, you'll see that bonds decreases and stocks increase without rebalancing because stocks perform better over longer periods of time in that scenario. So does rebalancing improve performance? Well, it really depends. Rebalancing can cause better or worse returns depending on the time period observed. However, over time, rebalancing tends to improve performance and reduce risk because stocks tend to increase in allocation if not reduced over time, which can lead to volatility. So you'll see here on the left from Business Insider, however, this time period from about 2002 to 2014, it looks like that rebalancing actually created better performance instead of just leaving the portfolio alone and not changing the allocations. So in conclusion, we've used these before from Napkin Finance, a great resource to check out. Kind of just sums up what rebalancing is. So it's basically buying or selling investments to manage a targeted mix of allocations. It's necessary because markets rise and fall. And so how to rebalance is you want to sell your strong performers and buy weak performers. And you want to be checking at least once a year to make sure that your portfolio stays with a good asset mix for your risk tolerance. Okay, up next, financial ratios and valuations, a primer. So these introductions are all to help with the content that we're going to be presenting today from some of our board members. So financial ratios, first off, what do they tell us? So from Wikipedia, from Investopedia, a great resource for all this stuff. What is ratio analysis? So ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements. Ratio analysis is a cornerstone of fundamental equity analysis compared to technical analysis, which is more like charting and looking at trends. So there's really 5 types of financial ratios that you can look at. One that we'll be spending a lot of time on today is liquidity, as well as leverage. So liquidity shows like how much like cash a company has on hand, like how well they'd be able to like liquidate assets and pay off their liabilities. Leverage shows how leveraged they are in terms of debt. So like how much long-term debt do they owe, and will that be an issue in the future? Efficiency/activity shows like how well they're producing goods, or like using the assets they have, how much profit they're making. Profitability ratios show like over time how much their investments in different assets returns profit for the company. And then market value ratios, those are used to compare different companies to one another in the same industry usually. So here's just a few examples. I would definitely come back to this slide in the future if you're interested in ratios. This will be in the general Google Drive. So you'll see here at the top that the profitability ratios, just one example is gross profit margin. Liquidity ratios, an important one is current ratio. Leverage, we also often talk about long-term debt to equity. And then activity and efficiency ratios, we'll talk about fixed asset turnover a lot, just seeing how much sales a company can make from their long-term assets. A quick reminder that I forgot to mention at the beginning of this meeting is that it's being recorded and that it will be put up on the general Google Drive folder. So if you aren't okay with that, let me know. But by signing onto the Zoom call, you're essentially consenting to have this recorded. Cool. Up next, an emphasis on liquidity and leverage. So today we're going to be talking a little bit more about these financial ratios because they're very important right now. We're seeing some turbulence in like corporate debt markets. And as you can see here, corporate debt's been on the rise compared to GDP in recent years. It's actually peaked and never really been higher in these past couple of years, even larger than the financial crisis. And some are saying that there's going to be significant issues in like high yield markets with companies unable to pay back their loans if they're not able to make sales during the COVID-19 crisis. Great. Up next, going to talk a little bit about valuation models and trying to project future returns. So what is a valuation model? Another definition from Investopedia. A valuation is an analytical process of determining the current or projected worth of an asset or a company. There are many techniques used for doing evaluation. An analyst placing a value on a company looks at the business's management, the composition of its capital structure, the prospects of future earnings, and the market value of its assets, among other metrics. Fundamental analysis is often employed in valuation, although several other methods may be employed, such as the capital asset pricing model, which we use when we are doing a DCF, or the dividend discount model, a DDM. So just highlighting some of the valuation models we often use and explaining what they do. These can all be used to value a project, a private company, a public company. It doesn't matter as long as you have the data for it. So up first, discounted cash flow model, one we often use. This essentially discounts future expected free cash flow to arrive at the present value of a company. It's important to use free cash flow because net income doesn't usually tell the entire story, and it's often manipulated by different line items or can be volatile based on the year. And so free cash flow gives us a better idea of the actual like cash flows coming into the company, and that can be found on the cash flow statement. Up next, the dividend discount model, similar except it uses dividends instead of free cash flow to arrive at the present value. This is used more for value companies which pay out higher dividends and have less growth. And then the earnings power value model. This is a very conservative model used to estimate the present value of a company based on zero to little growth in future earnings. So it's seeing like how much power their current earnings hold, their current level going into the future. And then finally, relative valuation. This can be used with some statistical methods as well, like using regressions to kind of compare companies in a sector to estimate what a company's worth using ratios such as price to earnings, a very common one, price to book, price to sales. And so essentially you can look at a company, and if it has a price of earnings of 12 and all the other companies in the industry have one that's 19 on average, then you may say, okay, well, this company may be undervalued, but you'd of course want to do a little bit more in-depth analysis before arriving at that. Up next, kind of looking at present value, which is a fundamental modeling concept, something that can be kind of hard to understand at first, but what it is from Investopedia is essentially it's the current value of a future sum of money or stream of cash flows given at a specified rate of return. So when we think about present value, we want to understand what a company or project will be worth in the future, but like right now. So this is the formula right here on the right, pretty simple. You're essentially dividing the future value of whatever you're valuing, divided by 1 plus the rate of return to the power of the number of periods. And so that's going to essentially allow you to estimate what something's worth right now if you have an idea of like what cash flows you're going to be receiving from this project, like what rate of return you're going to expect. This can be used in a lot of different value calculations. And so to kind of conclude this valuing discussion and also the financial ratios, it's important when we're thinking about companies in our portfolio or bonds or whatever it may be, to not think about what you have gained or lost on an investment, because that's gone, that's in the past. We can't get any of that back, but rather what your future return will be. So if we have a loser that's down 45% and we're like, oh, like we've lost so much money, maybe we should sell. Well, that might not be true because the expected return in the future might be 80%. So that means we could realize a much larger gain in the future, even though we're down a lot now. And similar with a company that's up 80%, we may think, oh, this thing's going to keep running forever. But in reality, it may only be able to go another 5% in value. So it's really important to think about this question.